Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. So, plenty to do this morning. We have our Research Director, Camelia Kuhnen, here with us today. She's going to go through the employment numbers that have just come out. She's going to put those in context with some other economic data that we have to look at. There may be a mention of the Fed, and she's also going to talk about consumer confidence and consumer sentiment, one of her specialties. So we have a lot to look forward to. Before we get to that, we'll do the rules of the road real fast. Professor Kuhnen will talk to us for 15 to 20 minutes. Then we'll switch over to a Q&A session, and those will be your questions. You can submit those to us at any time using the question and answer function at the bottom of your screen. If you're with us by phone today, you can also send in a question. You can email it to me at rob_knapp@kenan-flagler.unc.edu. If you're a member of the media, we try to prioritize your questions. So if you submit one, please include your name and your organization along with it, so we'll know to put that one toward the front of the line. I think that's everything you need to know. We'll go about 30 minutes today, try and get you out in plenty of time for your 10 o'clock this morning. So let's move on with things. Again, with us this morning is the Institute's Research Director, Camelia Kuhnen. Cami?
I am here.
All right, hope you're doing well this morning.
Thank you. I will start my video in just a second here.
All right.
There you go. Good morning, everybody. We have a lot to talk about today. I'm going to share my screen with you. Lots of slides to go through, lots of numbers, some good, some not so good. So as you might remember, last month when we got this report, things looked surprisingly bad. There were some revisions of previous payroll numbers. And unfortunately, this month, the jobs report is not a strong one. It actually continues to provide evidence that the labor market is softening, maybe in a way that's a bit more accelerated than anybody expected. So the expectation was for the change in non-farm payrolls for August to be an increase of 75,000. Instead, that number came to be 22,000, so lower payroll numbers than we thought by quite a bit. On top of that, while we revised the July payroll numbers up a little bit from 73,000 to 79,000 because of the arrival of new information from the surveys conducted by the BLS, the June numbers were actually revised downward quite a bit, so that, in fact, the change for June is a negative one. We lost jobs in June. In terms of manufacturing payrolls, the number again came to be worse than what we expected. We have a loss of 12,000 for August, and this is actually the fourth month of decline in manufacturing jobs in a row. Construction is another industry where we've seen now multiple months of contraction in terms of number of jobs. This is the third month in a row. So things are not really looking good in terms of jobs added to the economy. In terms of hourly earnings, we're pretty steady, and honestly, this is a bit of a surprising thing. Hourly earnings have increased month to month by 0.3%, which is at or slightly above the rate of inflation. So people are still, in real terms, gaining a little bit, in spite of what we see as basically a sort of weak labor market. Number of hours stayed the same, or shown a very, very small decline. But I'll tell you a bit later that some information we got yesterday also from the BLS, from a different report, that says that while the number of hours hasn't increased, actually there might have been increases in the productivity observed in the U.S. economy. So a little bit more on that later. The unemployment rate is pretty steady. It's 4.3%. It was 4.2% in July. So it's a small increase. It's relatively low by historical standards, but the trend that we've observed throughout this year is not a good one. We've been seeing this this ticking up of the unemployment rate pretty much throughout the year. And then finally, the labor force participation rate is a little better than we expected at 62.3%. But I will tell you more about this. This particular figure here has been in decline for quite a while. And this, if I were a policymaker, I would be quite concerned about the relatively low labor force participation rate and what this means for the future of US economic growth. So here you see the pattern in the changes in total non-farm employment, the payrolls number, and these numbers look great. Every month we saw an increase in this number for the previous 3-4 years, but now in 2025, these monthly numbers have been quite low. And again, because of the revisions that we've just received for June, you see there is a negative number for that month, meaning we lost jobs in June. This is not good. This is not a sign of an economy that's expanding in a healthy way. In terms of pay, like I said, the wage growth is steady. It's close to 4% year on year. It's something like 3.8%, and it is still above inflation, which is good for workers. Now it's not really good if you think about wages putting pressure on inflation and wage growth. If it's too high, it's going to make us think again about inflation. But we did get some data yesterday from the BLS on their reporting for Q2 unit labor costs. We actually learned yesterday that the productivity in the US economy in Q2 was shockingly high compared to expectations, 3.3% versus 2.5%, and increase in productivity. And interestingly, the unit labor costs numbers came to be pretty small for Q2. So we might be actually seeing a slowing down in payroll costs for employers, and that's coming not in terms of a change in the amount we pay workers per hour, but in terms of the amount we pay them per unit of whatever they're producing. So we're becoming actually more efficient, more productive somehow, if you believe the Q2 numbers, which I do, and I hope they're telling us more about what's to come in terms of productivity gains. More on productivity in just a couple of minutes. Now, unemployment. The unemployment number is 4.3%. Again, you can say relative to what we've seen in the past, it's not a bad number. It's pretty close to historical lows, but it has been ticking up significantly, as you can see in this picture. So the labor market it's been getting weaker throughout the year. We can't really hide it. That's just how it is. And it's sort of an interesting situation where the number is still relatively low because both the supply and the demand of workers have actually diminished. So immigration has done something to the supply of workers, has lowered that, and the demand for workers it's weaker because firms have been faced with a lot of uncertainty that's coming from economic policies about trade and immigration, and that has delayed investment, has basically put a freeze on hiring. So because of this interesting lessening of both supply and demand, you're actually not seeing the unemployment number go up very fast, but it's been creeping up, and that's a concern. Another concern that I have that I wish people were talking a bit more about is the labor force participation rate. If you look at this picture, it tells you that back in I think it was April 2000, we reached a peak where if you looked at the entire population, 16 years and older, who in theory could be in the workforce, back then 67% of them were in the labor force. This was the peak of participation, and then that number just went into pretty much a free fall. COVID did not help. It reduced the participation rate to almost 60%. It's been going up after COVID, but as you see in recent months, it's been going down again. And you cannot have a strong economy, you cannot have fast economic growth if you don't have people participating in the labor force. And it's interesting to understand why that's the case, why people stay on the sidelines. I think as a policymaker, I would definitely look into this and try to fix this participation issue. If you look at prime age workers, for men the participation rate has been pretty steady, but for women we've actually seen in the past few months a decline. So I worry a bit about prime age women dropping out of the labor force. You also see clearly for older adults, those 55 years and older, that there's been a steady decline after COVID in the rate of participation in the labor market. And these are people who are skilled. These are people who can teach the new generation of workers what's important for their jobs, and they're not in the labor force. So this is a concern. I'm not sure how to get these people back into the labor force, but they're clearly not interested in being there as much as they used to be. And then the other thing I wanted to show you is the labor force participation rate for young individuals, those who are 16 to 24 years old. That number was very high back in the 80s to the 90s. Young people were working. They were in high school, they had a job on the side, were in college, they had a job on the side, and so forth. Now that rate has dropped because if people are in college full time and they do not work, also do not have a job on top of that, they're not counted as being eligible to be in the labor force. So the participation rate, that drops if more young people go to college. But if you look at this number since after the financial crisis in 2008, 2009, that number has been staying flat, even though it's not the case that we've seen more and more people do college full time. So there's something about young people these days not being interested in being in the labor force, whether or not they are in college. And I'll show you towards the end some data that says that some of them might actually be discouraged and not really see a lot of opportunities in the labor market, or sort of a positive outcome that they could get by being in the labor market. And since we're talking about young people here, I wanted to bring a couple of statistics that are quite I don't know, surprising, I would say. So you can think about splitting the jobs in the economy in sort of two categories: white collar jobs and then those that are in the what's called the essential economy. Think about the people in construction and agriculture, people in skilled trades, the plumbers, the electricians, people in transportation, energy, manufacturing. So these are the people who basically they work with their hands. They of course use technology, but they cannot be replaced by an AI bot. They have to be there and fix your the infrastructure. So it turns out that if you look at the productivity of these two parts of the economy, the white collar economy versus the essential economy, the productivity growth we've seen since 2015 has been very different for these two. So in the white collar economy, productivity gains have been in the range of 28% since 2015. We got better, if we're working with computers in offices, we have Zoom, we have technology that makes our life easier. We can be more productive. Much more so than we were back 10 years ago. But in the essential economy, if you look at the productivity gains, basically they were either at zero or a little bit negative. We've lost maybe something in the range of 3% in terms of productivity. In construction, the level of productivity is basically back where it was back in the early 1980s. So there is something that's not right in terms of how we innovate and how we drive productivity in a large part of our economy. Out of the roughly 160 million jobs in America, 95 million are in this essential economy that's seen very little productivity gains. So again, if I'm a policymaker and I'm trying to think, what can I do to spur economic growth? I am concerned about the ticking up unemployment rate. I should be concerned about the low labor force participation rate, especially if I look at young people. And then I should also be concerned about productivity and how on earth I need to get that number up. And it turns out that, to spur productivity in this essential economy, what you need to do is to invest in training programs. You need to invest in programs that provide skills to people who need to be retrained, who need to be working in these sectors. And it also raises very big questions, I think, about what the education system, what the college system, the community college system is doing to provide the right skills for people who will need to work in this essential economy. How can we, as an educational institution, for example, teach our students things so that the productivity of these kinds of jobs in the essential economy is going to be increasing much faster in the future? These are big questions, but I don't want to lose sight of them by looking at just sort of month by month what's happening to the unemployment rate. We need to keep the big picture in mind, and the big picture is we need more people to work, and we need them to work more productively. And this is not just the case of people in white collar jobs. I'll tell you a bit more about some data from the labor market that also says that things are not going super well. The JOLTS report came a couple of days ago, We were expecting to see 7.4 million job openings in July, just like in June, but the number came to 7.2 million, so fewer job openings. Interestingly, actually, some of our error in forecasting the job openings came from healthcare. So we were expecting to see more healthcare jobs open or being available, but that number came down, was lower by about 180,000 relative to expectations. So there's a question whether or not healthcare is going to become less of an engine of hiring than it has been for the past several years. Basically, half the jobs, if you think about half the jobs that we've seen added to this economy in the past couple of years are coming from healthcare and related sectors. So in the JOLTS report, that had a little bit of a weak reading. So we'll have to we have to hope that the industry stays strong. It should. Why? Well, this country is an aging country. As people age, they need more healthcare, and so we probably will need more healthcare workers. But this particular reading for this month in JOLTS was not very good for healthcare. Other numbers, though, in JOLTS stayed pretty steady. The quits rate was at 2%, just like as before. The highest rate was 3.3%, just as before. And the layoffs rate, this is a very important number, also stayed steady relative to the previous month at 1.1%. So this is telling me that the labor market is not just spiraling out of control. It is softening. It's I think that employers are cautiously just sitting on the sidelines, trying to let this uncertainty about various policies from immigration to tariffs settle down a little bit before they can make big decisions about either hiring more people or laying off people. But in the past, once the layoff cycle starts, you learn from past data, basically it goes down really fast. So what we don't want to have happen right now is to have the layoffs really become a big deal. If I were the Fed, I would be very worried about this layoff cycle. A similar assessment about this is a slowing down job market, we need to really pay attention to it, is coming from the ADP employment report and from the initial jobless claims report that we saw yesterday. Again, the numbers that we were expecting to see in those reports, well, when they came out, they were a little bit worse than expectations. So things are slowing down, maybe more so than we had imagined. In terms of economic growth, if you look at the GDP, the growth rate of GDP in real terms, Q2 looked good. 3.3% annualized rate of growth of real GDP. That followed a decline of 0.5% in Q1. You might want to be very happy about the 3.3% number in Q2. However, that was driven primarily by a decrease in imports. Just mathematically, that's what happens if imports go down a lot. That makes the GDP number look better. Now, it was also driven, that increase in GDP, by an increase in consumer spending, but it was much weaker. An increase in consumer spending than what we had seen in the previous couple of years. So consumers, they have been trying to spend, especially in Q2, but not to the same level that we've seen in the past in terms of growth rate of consumption. There are forecasts, of course, for GDP growth later in the year. The consensus, the blue chip consensus for 2025 Q3 annualized real GDP growth is about 1%. So we are all expecting weak growth. Why? Because again, everybody's sort of sitting on the sidelines. Firms in terms of hiring or in terms of laying off people, consumers in terms of spending. And this is because the level of uncertainty, policy uncertainty, has been incredibly high. It peaked in April when we had the Liberation Day, and then that uncertainty did drop over time to some extent. It's not all the way back to what it used to be in late 2024. So firms and consumers continue to be quite uncertain about the future of the economy. Small businesses also, if you look at their data, one survey, they also indicate the uncertainty continues to be very high. Their uncertainty dropped a little bit in the summer, but then peaked back up when there were renewed conversations about tariffs and how they might change in the recent weeks. So uncertainty is a threat to economic growth. Very much any economist would tell you that. We need this uncertainty to drop to more normal levels. It's not happened yet. And until it happens, I think everybody's going to be very careful in terms of investing, in terms of spending. The inflation rate has gone back up to about 2.9%. It's not close to the 2% target. And depending on who you listen to and who measures this, the forecast for inflation over the next 6 months or so is anywhere between 3.25 to 3.5%, because the understanding is that a bunch of firms are now going to pass through some of the increases in their cost to consumers after holding back for some number of months. So Walmart, for example, or Ace Hardware, they said that you will see price increases in the future. And other companies have, Procter & Gamble, for example, they've expressed concerns that consumers will be able to sustain or to pay for these goods and services once prices increase. So we are worried about inflation still. However, because of all of the signs of weakness in the labor market that we've seen, the Fed will shift their attention to the labor market. So very, very likely they will push down the Fed funds rate at their meeting September 16th to 17th. By a quarter basis point. You can also track expectations for the Fed funds rate in the future using the CME FedWatch tool. And that this morning, when this week jobs report came, you actually saw that for a year from now, if you looked at what people expected for the Fed fund rates to be at, that number basically this morning dropped by 0.25%. So everybody believes that there will be a bunch of cuts. Now, actually one more cut in the next year than we were thinking as of yesterday. So probably by September 2026, the Fed funds rate will be somewhere in the neighborhood of 2.75 to 3%. So about 6 cuts of a quarter basis points, and to start in September, pretty much guaranteed. And so let me just say a few things about consumer confidence. Now, basically, consumers they're not sitting pretty. They've not had a very high savings rate for a while now. It's only about 4.4% savings rate in July. The labor market softening. They're concerned about finding a job. There's a lot of uncertainty in terms of economic policies, and so probably that's going to make their spending not grow super fast in the remaining of the year. The consumer confidence data does show that indeed households are concerned. The consumer confidence improved early, before April. Then April came, the confidence or sentiment dropped because of concerns about tariffs. Got a little bit better over the summer, and then again dropped because we have recently heard that maybe the tariff situation is not yet resolved. So consumer confidence is not looking good. People are worried about inflation quite a bit. They expect it to be quite high, far from the 2% target of the Fed, and that's not good for the Fed when they're trying to anchor those inflation expectations. And right now they have to take their eye from that, and basically do something to help the labor market by reducing interest rates. To basically make it easier for firms and for consumers to invest and get access to funds. Now, that being said, households do have balance sheets that look fine. They're sitting on net worth that has been increasing in real terms year on year for a few years now. But the pace of growth of net worth has been declining in 2025, right? So if you're asking yourself, how much better off am I now? If I look at my balance sheet, I'm still a little bit better off compared to the past year, but my level of how much better is not quite as high as it was a year ago or 2 years ago when I was comparing myself to time periods before that. So the pace of growth of net worth has been slowing down. Homes are still worth quite a bit, and a lot of households own homes. And I believe that homes, basically, because they have increased in value since COVID by basically 50%, I think homes gave households the confidence to go ahead and spend because they were sitting on an asset whose value increased dramatically. But that pace of growth in home values is slowing down too. So balance sheets are fine. Maybe the increase in the value of assets is not quite as high as we saw it be in the previous couple of years. The last thing I want to say is about young people again. Remember, young people had a low participation rate in the labor force. Well, in terms of their confidence in the American economy, we've seen this year something that's very unusual. Young people, those 18 to 34, are basically now more pessimistic about the future of the US economy than older people. And this is not seen before. If you look at this picture, the blue line is the confidence of young people. It tends to be above the confidence of the other age groups, except for this year. This year, you've seen young people become equally pessimistic or even more pessimistic than older people. And this is not good, because if young people do not have confidence in the future of the US economy, they're not going to make the types of investments that they need to make. They will not become innovators. They're not going to become entrepreneurs. They're not going to get education that has high returns in terms of, again, having high productivity and leading to more innovation down the road. So I'm worried about young people. And their lack of optimism is driven by objective things. So if you look at this picture, it says to you that the level of real wealth of this group of young people, the blue line here, that's been pretty flat. Their level, in terms of the standard of living, has not improved for the past several years. It definitely improved more for older people, but not for the young generation. And the last thing I'll tell you about the young generation, especially people with young college graduates, is that there's a pattern going on here that's really unusual. Look at this blue line here. The blue line tells you the unemployment rate for recent college graduates, age 22 to 27. Normally, up until COVID happened, that blue line, the unemployment rate for recent college graduates, was below the black line, which is the unemployment rate for the overall population. I mean, it makes sense. You have college degree, you're young, you're energetic, you should probably find a job. But that changed after COVID. The blue line is above the black line. Basically, young college graduates have a higher unemployment rate than the broad population. And this has to be disheartening. If you are a young adult and you're trying to get your life started, this must be very very difficult. Again, it means that somehow we're not training these people to have the right skills, or we don't have the right jobs available for them in the economy. And this is something that I hope policymakers are going to think about in the future. All right, so to wrap it up, I think probably we'll just have slow economic growth, probably not a recession in the next 6 months. But this will all depend on how fast we can wrap up the this high level of uncertainty about tariffs and immigration policies. Whether we have a recession or just a slowdown will also depend on how firms respond to things. Like I said, there was a report yesterday that shows that firms somehow became more productive in Q2. So maybe having all this uncertainty forces us to become better at how we do our jobs. But also what the Fed does with interest rates will play a role again into whether or not we see a slowdown or a recession. If we see if they're not fast at lowering interest rates, probably we will actually see a recession. But I think that they're on it. They're not going to let it happen. So my forecast is weak growth for the next 12 months or so. Probably we'll keep seeing labor market conditions worsen for the next maybe quarter. Inflation probably will be close to 3.25, 3.5% in the next 6 to 12 months, because we will see pass-through of tariffs to consumers. And we should expect to see about 6 rate cuts in the next 12 months. And that's all I got.
That was a lot, Cami. you covered a lot of ground. There's a lot to talk about today. We gave people a ton to think about. So those of you who have questions, we're still going to have time for a couple. Hammer that Q&A function button at the bottom of the screen if you want to get a question to us, and we will take a go. I know there's a lot of information to consider at this point. So Cami, we'll start off with this one. As most of the folks that are with us today know, about a month ago, actually it was the day of the economic briefing and the employment release last month, the president fired the Bureau of Labor Statistics commissioner. That position has not been filled yet, although we have a nominee. So has any of that changed the way we should look at this employment report?
Not yet. Absolutely not yet. The BLS for this particular report has used the exact same processes to collect the data, analyze it, and put the report together. This is a very well organized process by which they come up with this report. And by the way, the BLS commissioner has no input whatsoever, or historically has not had any input in this process. They only see the final data the Wednesday of the week when the report is to be released. So as of now, nothing has changed in terms of how the BLS comes up with these numbers. I fully trust these numbers.
Okay, very good. Let's see. Here's a question from Kirk Redmond. Thank you very much, Kirk. When looking at labor force participation rate, which you talked about, does the data capture workers who do gig type work like Uber or freelance labor, but not as a full-time job?
Yes, it should.
Okay. Very good. We've had a lot of talk lately about revisions. So I know it's impossible to predict whether there's going to be a revision, but is that something people will probably keep in the back of their minds after seeing this number, that there could be movement next month on that number?
Definitely. So the way these numbers are collected, the BLS asks about 120 establishments in any given month, roughly in the middle of the month. They ask them to report things about, jobs and payrolls. And these businesses have 3 chances to report. They can give you the report right away within the next almost 3 weeks after they're asked. And that data is what this preliminary number is based on, is from the businesses that report within 3 weeks of being asked in the middle of the month. And then there could be 2 additional points at which businesses asked in the past can report. So they have another additional 2 months to come up with the information. And so we will see 2 more revisions of any monthly number. So can the August number be revised? Absolutely. And it is indeed the case that in the first wave, if you wish, of responses, only something like 60% of the establishments provide information. So the response rate is not great. It does get better by the third wave. Basically, 94% of establishments do report. So the final number is fully to be believed. But given that only roughly 60% probably responded so far for August, probably we will see a revision next month or the month before.
Okay, good stuff to keep in mind. Another question: if healthcare continues to slow as a hiring growth source, how will this impact the rest of the economy?
Well, not in a good way. We need jobs, but like I said earlier, I find it hard to believe that we will not keep hiring a lot in healthcare because the U.S. population is aging and quite fast. And we will absolutely need more people to provide healthcare services, including, in-home healthcare. Yes, we will have technology help a lot with healthcare services down the road, but we're not there yet. If you have to take care of somebody in the hospital or at home, a human will have to provide most of that care. And so bottom line is, I think that this probably is a temporary drop in hiring in healthcare, or I'm talking about the JOLTS report, a temporary drop in the number of openings that we see in that industry. It is possible that there was a lot of hiring in healthcare earlier in the summer, so maybe employers now are just taking a little pause. But I do not see this to be a long-term equilibrium of there being no demand for healthcare jobs. Pretty sure that we'll see them.
Okay. As you said, we are an aging country, so.
Unfortunately, that's not good, right? Remember, productivity, labor force participation. Turns out as people get older, they participate less. I mean, I know the feeling. So, but we need more people who are to be in the labor force and to be super productive. Absolutely.
Okay. Let's zoom in locally a little bit. What does this national jobs report mean for the NC jobs report that will come out later this month?
Well, I think that North Carolina is probably a sort of a good microcosm of the U.S. economy. So I would expect to see similar patterns there in terms of jobs in manufacturing or construction. Probably not going to see a huge increase in those. I'll be curious to see what happens to jobs in education in North Carolina. It's at the broad national level. There's been some increase in jobs in education. And leisure and hospitality. I'm sort of hoping to see the same in North Carolina, an increase in those types of jobs.
Okay. One more, and we're going to call it a day. This one's from Dan Barkin at Business North Carolina. He says, are there ways that you can quantify uncertainty besides VIX or something like that?
Yeah, so I was showing today 2 types of uncertainty measures. One of them is the economic policy uncertainty index of Baker and Bloom and Wegler. And that index is based on mentions of words that relate to economic policies and uncertainty about economic policies in a variety of news outlets. So you basically measure how focused the press is on uncertainty about economic policies. And then the other measure that I showed was from a survey of small businesses where they're just asked how uncertain they feel about future economic conditions. And these 2 measures have nothing to do with the VIX, or they're not, a direct proxy for the VIX, which is a volatility measure that's based on fluctuations in prices of assets in equity markets or derivative markets. So financial assets volatility, that drives the VIX measure. The other two measures that we saw today, they're coming from either surveys of businesses or they're coming from what the press is covering.
Okay, very good. Let's call it a day. Camelia, Kuhnen, thank you very much. For some briefing mornings are a long way to go and a short time to get there, and this one was definitely one of those. So thank you for your great and timely analysis. We appreciate it. Thanks to all the attendees out there and their questions. We appreciate those too. They help make us better, and we are glad for it. For anyone in the media out there, if you want to continue the conversation, we'd love to do that. If you'd like to talk to Cami or any of our experts about any of the topics we talked about today, you can email me at rob_knapp@Kenan-Flagler.unc.edu. For everyone out there, we hope you'll visit our website at kenaninstitute.unc.edu. Always a lot going on there, including our grand challenge this year about the skills gap. And we talked about some things today that relate to that as well, participation rates and things like that. And here's the part of the show when I find out if my day is going to go well. I'm going to try to share something. Okay, I think that's working. So we're about a month out from the Frontiers of Business Conference, which is Bridging the Skills Gap this year. It's our biggest conference of the year, and we hope that you all might be a part of it too. There's information on the screen there. We've also got a discount code for the attendees of our September briefing. You will notice that that code is September briefing. You see what we're doing there, right? So you can use that to register, get a percentage off. You can also go to the website, just get some more information about who will be speaking there. Cami will be one of the folks from the Institute leading a panel there. So there will be a lot to talk about. We hope you'll join us for it. And if you need more information, go to frontiers.unc.edu. All right.
Thanks, everybody.
Thank you, Cami. Thank you, everybody. We appreciate you being here. We hope to see you next month. And so until then, enjoy your Friday.